Welcome to this edition of Market Compass, in which we'll dig into the change in market leadership we are seeing in 2026 so far. Giant technology companies have been the runaway market leaders over recent years. An investment in the so-called Magnificent Seven back at the start of 2023 would have more than tripled in value, representing an astonishing run and far outpacing the returns in other parts of the market. However, 2026 has been a different story. Tech companies are lagging the pack, with the same Magnificent Seven group down 6.5% year to date. Meanwhile, a more diverse set of companies across a wider range of sectors and regions have surged ahead. We think this rotation provides an important signal for investors. Improving economic and corporate fundamentals are creating attractive opportunities outside of the US tech sector, underlining the need for well-diversified portfolios to help take advantage of a broadening in market leadership. We'll dig into these fundamentals, but let's start by examining the recent tech wobbles. Critically, these don't seem to reflect deteriorating near-term earnings. Instead, after an incredible run and with valuations elevated, investors are seemingly becoming more cautious for a couple of reasons. First, we are seeing markets look to discriminate between the winners and the losers from the AI revolution. Software companies are the latest to struggle as investors weigh up the potential of AI to disrupt their business models. Second, markets are balking at some of the enormous investments pouring into AI infrastructure, with an increased focus on the returns from these outlays. Against this backdrop, investors are seeing opportunities in cheaper parts of the market with seemingly improving fundamentals. All 11 sectors of the S&P 500 are expected to deliver higher earnings this year, with many seeing double-digit gains. A solid economic backdrop, tax cuts and lower interest rates are helping underpin this improvement. And business investment is accelerating. While some of this strength reflects the AI data center boom, we are seeing signs of a broader pickup in CapEx spending, which is likely helped by the more favorable tax treatment of these outlays put in place in last year's tax bill. Similarly, we are seeing indications that the freeze in hiring over 2025 is thawing. Private payrolls growth is picking up through the turn of 2026, which is another signal that firms are feeling more upbeat. Importantly, a pickup in hiring should help support ongoing consumer spending, the key engine of the US economy, as should the boost from last year's tax package, which looks set to deliver $150 billion in tax refunds and lower withholdings this year. Finally, the economy should feel the benefit from interest rate cuts last year, and we continue to see scope for one or two more rate cuts, even if we think these might have to wait until some of the tariff-driven inflation starts to fade in the second half of 2026. All in all, we think the economy looks in solid shape, and this assessment is seemingly shared by investors who have been moving in to more cyclical stocks and smaller companies, which tend to be sensitive to domestic growth and interest rates. And this is not just a US story. There are signs of improving global growth momentum, particularly in the cyclical manufacturing and trade sectors. Additionally, many economies overseas are set to benefit from looser fiscal policy, like Japan, lower interest rates, like emerging markets, or even both, as is the case in the Eurozone. Finally, a further depreciation in the dollar has helped bolster returns from international equities for US-based investors this year. Stepping back, we think the broadening in market leadership this year presents an opportunity for clients to diversify portfolios and ease concentration risks. We continue to prefer allocations across US large and mid-cap equities, international small and mid-cap stocks, and emerging market equities too. Speak to your financial advisor to consider if you should look to broaden your investment horizons in 2026.